With the conception of digital, unregulated markets like cryptocurrency, it is now more prevalent than ever for consumers and traders alike to be watching their wallet. There's been some less than elusive tactics deployed in this market, and as we've seen in some cases, dumb money follows. Bitcoin's enthusiasts claim that cryptocurrency will save us from the big brother of centralized banking, but what if in some twisted way of irony, Bitcoin's unravelings was actually the very same problem it set out to solve, namely the fiat printing press, except this time it was being used to prop up the Bitcoin bubble from its inevitable collapse. Will this be the trigger event that causes the house of cards to come crashing down once again? Many are being led to believe that Tether may be insolvent and is now printing hundreds of millions of dollars in tokens to propel the price of Bitcoin above the psychological $10,000 level. But to explain this, let's first start at the beginning. What is Tether? Tether, otherwise known as USDT, is often referred to as the tether or link to the US dollar. Tether, by definition in the white paper, is a digital token backed by fiat currency providing individuals and organizations with a robust and decentralized method of exchanging value while using a familiar accounting unit. And the goal seems simple enough, right? Tether exists because there's demand for a stablecoin, a coin that traders can move their money into when they believe the market will decline. However, exchanges offering actual USD balances to customers mean that these companies have to comply with anti-money laundering and know your customer laws. Some exchanges like Coinbase, Gemini, or Kraken have decided that complying with Uncle Sam is worth it, which is why you're required to provide legal documentation to trade on these websites, such as your driver's license or social security number. Other exchanges such as Bittrex, Poloniex, and Bitfinex may not require your personal information, but are required to deal only in cryptocurrencies. The solution? Tether. Before diving deeper, let's create some context. Although previously denied, Bitfinex and Tether Holdings have been proven to be part of the same corporate entity. In an event similar to the Panama Papers, dubbed the Paradise Papers, new information gave us insight into who was registered under Tether Holdings Limited. One of the directors listed is Phil Potter, who is also known as the CSO of Bitfinex. Although Bitfinex claims to trade on a USD pair, it is more than likely USD Tether. Due to the severed ties with Wells Fargo and the slew of other banking issues Bitfinex has faced, customers have made it clear that deposits and withdrawals of USD are simply unusable on the exchange. In November, an article written by Lily Katz of Bloomberg points out an underlying catch-all hidden in Tether Holdings policies, which states, "Tethers are not money and are not monetary instruments. There is no contractual right or other right or legal claim against us to redeem or exchange tethers for money. We do not guarantee any right of redemption or exchange of tethers by us for money." Since then, Tether has quietly updated their policy to read, "Absent a reasonable legal justification not to redeem Tether tokens and provided that you are a fully verified customer of Tether, your Tether tokens are freely redeemable." Which for a moment almost seems more reasonable, but when you try to sign up as a customer, you're met with an error stating that registrations are closed while the system is being rebuilt. This update means that Tether is only redeemable by Tether Holdings if you're a customer of them, which as of today you cannot become. So, does Tether actually have the money they claim? Truthfully, we do not know. It is written explicitly in their white paper, on their website, and in their policy that every Tether created is backed by $1 US. The decision of frequent audits of the reserve was made by Tether Holdings to ensure transparency between the company and the customers that used it, and in March of 2017, provided they did. In April of 2017, Wells Fargo has decided to sever ties with Bitfinex and Tether Holdings, which no longer allowed them to use the banking structure they once had, and the audits soon stopped. Later in December, Tether published a memorandum compiled by Friedman LLP. This document claimed that Tether had the $442 million in reserve to match the 442 million USD tethers that had been printed at that time. However, formally written at the top is a notice which states, "This information is intended solely to assist the management of Tether Limited management and solely for management's use and is not intended to be and should not be used or relied upon by any other third party." Although Tether Holdings never claimed the memorandum was an audit, certain names, account numbers, and other personal details were redacted from the document. Tether has gone to publicly state that it would be a mistake to be too forthcoming about the specifics of any particular money transfer solution. This is likely linked to the banking incident that happened with Wells Fargo back in April. Phil Potter, CSO of Bitfinex, has voiced his opinion on the banking problem as well, saying,
We've had banking hiccups in the past. We've always been able to route around it or deal with it, open up new accounts or what have you, shift to a different corporate entity. There've been lots of sort of cat and mouse tricks that everybody in the Bitcoin industry has to avail themselves of.
After filing and then dropping a lawsuit against Wells Fargo, Bitfinex/Tether Limited have now resorted to hiding behind shell companies so that banks cannot identify them as the sender or recipient of transfers and block them. Some of those shell companies have been exposed, such as Crypto SPZOO, using an account in a small Polish bank. This is likely the reason why Tether Holdings claims to be only interacting with their biggest customers. If their banking details were needed to be kept quiet, it would be much easier retaining that information between only the biggest players. So why does this matter? Well, although that we've known that Bitfinex and Tether Limited are unable to produce an audit at this time and have had issues with their banking solution for the past 10 months, new Tether is being added into the market at an alarming rate. To understand why this is an issue, we have to learn how Tether works. Why does Tether equal $1? There is only one direct trading pair for USD Tether, which is on Kraken, but as mentioned earlier, USD Tether and USD are also traded through the proxy pair of Bitcoin. For example, if one Bitcoin was selling for $15,000 on one exchange and 14,500 USD Tether on another exchange, both bots and humans would buy the $14,500 Bitcoin and immediately sell it for $15,000. This is called arbitrage and would allow the USD Tether price to equal $1. Why does Tether not equal $1? Generally, in times of volatility, the demand of Tether can increase. When prices go above $1, Tether Holdings steps in, forging an appropriate amount of new Tethers to sell for $1. Since the market rate is above $1, there should be no shortage of buyers. This increase in supply causes the USD Tether price to decline, and the USD that Tether Holdings bought should now be backing the Tethers they sold to the market. When the price of one USD Tether drops below $1, things get a bit more interesting. According to the white paper, what should happen is that traders will buy the USD Tether at that price, thus pushing it upward, and then sell it to Tether Holdings directly at the promised rate of $1. Tether will then burn or destroy these tokens, taking them out of the supply and helping consolidate the price at a lower level. We already know that redeeming USD Tether for USD from Tether Holdings is difficult for anyone who is not a customer of Tether, but what's also interesting is there doesn't appear to have ever been a record of any USD Tether tokens ever being burned. In the event of investors losing confidence in Tether, the price will skyrocket on USD Tether exchanges and drop on USD exchanges, as people holding USD Tether start to panic buy Bitcoin and then transfer to a USD exchange to sell and cash out. So what now? The market supply of Tether was around $50 million as of April 2017, but has now grown to over $2 billion. Keep in mind that the New York Times, Bloomberg, and the Fortune magazine were already ringing alarm bells when they heard that the number was at 500 million. The amount issued in January has been truly astounding, with 100 million being added each day for 6 consecutive days, which would not be considered a problem as long as they've been receiving fiat US dollars for every USD Tether they create. And if they don't, then Tether is participating in what is known as fractional reserve banking, which is where a company only holds a fraction of debts owed. While not an uncommon business model, Tether is not held liable for any losses in debt, which leaves the investor holding Tether with no course of action if the price crashes sharply. If Tether is found insolvent, the results could be catastrophic on the entire cryptocurrency market.